is that like when you go on a diet, like right, you want to lose fat and like not muscle.
Mm,
And so for a lot of business owners, because it's like their own bottom line, I want to first say that I like really feel you, but let's like trim the fat and like keep the muscle. And so the mistakes that I see for business owners is that they like start freezing everything. And it's not just the risk part, but like the opportunity, you know.
the things that to stay resilient is really watch the behavior of the customers.
Hi, everyone, and welcome to Objectives Money Signals Roundtable. We're super excited for you to join this conversation around leading indicators, middle market strategy, and navigating the macroeconomy in 2026. We have with us Jordy, Jenny, Tristan, and Dr. Jaime. We are going to talk a little bit more about how business owners impact the monetary policy long before it shows up in data. So with that, I'm going to hand it over to Jordy, who's going to kick us off.
All right. Thank you, everyone, for being here. I'm super excited about this panel. Got a great panelist here, Tristan, who's an operator, and he's going to kick us off with one of the hardest questions. Tristan, as an operator in a capital intensive, low margin business, what were the first signals inside your company that told you that monetary conditions were tightening even before the deadlines confirmed it?
Uh, well, the earliest signs were not just it's the shippers. We felt there was a big change in their behavior from going from their contracted rates to the spot market rates, which
Mm.
collapsed our rates. And with that, there was also the um, you know at the same time, the demand has softened by our customers shipping less and with less frequency. That means with the demand down and there's with the shippers going on the spot market, crashing the rates, it was just a perfect storm to know like, wow, it's definitely changing. The behaviors are changing, and you just have to figure it out. And we knew that it was just going to keep crashing and crashing and crashing. And that's how it usually happens in trucking. We see it first, especially with shippers' behaviors and also them shifting their contracted freight into the spot market, which is horrible because that the guys that had the contracts are have these fixed expenses. And so with their fixed expenses, they start falling apart. And then it starts that comes down to us as the spot market operators where we're giving out our trucks to all different shippers, so or brokers in this case too. So yeah, that's
So
that's what happens. It
yeah,
oh,
they say the smartest people are the ones that can see around corners, but I find it incredibly difficult because you're running a business, right? It's hard to be paying attention to a million signals and seeing what's going on. But I know you guys were able to kind of move forward and keep going, even though you have a double pressure, right? Interest rates were rising, customers were pushing the price down, moving to spot makes things very volatile. So how did that double pressure change the way you operated and thought about your capital?
Oh, capital, that one's hard because, the other thing is the cash behavior. Customers start paying later. You start
Wow.
to, they stretch out. They go from 30 days to 45 to 60 to 75 to 90 days. And they're also pushing down the rates, right? So it's difficult because the cost to carry that money, we start looking for banks to finance us. So if you guys have ever heard of factoring, so that's another
Mm.
expense that we have to take. But not only that, what that did for us is it forced us to press the brakes and from growing. And literally we just had to make hard decisions to downsize. I mean, at our peak, we had 18 trucks, and then we just went down to 10, and now we're at 4. So we're absolutely like no growth, no new equipment purchases. We're selling off equipment that are non-essential, and we're prioritizing the cash or preserving cash over growth. And we also shifted to optimizing our lanes. Like wanted to go to more profitable lanes. We weren't just moving trucks just to move trucks. And we were just wanting to survive and to have flexibility, with what we had. And because there's only four ways to make money in trucking, and it's raise the rates, which we couldn't do, cut costs, which you can only cut costs so much. And if you ever see our insurance rates and our fuel, those are always volatile. They always go up and down. And then truck utilization, picking the right lanes for us, making sure our trucks are running at all times with, the 7 days available for us to run in a weekly basis, or get out of trucking. I'm just kidding.
You don't want to take that option. Yeah. No, but you're right. I mean, you can't cut costs so much. You can only think about your revenue when there's growth opportunities. But being really keen on operations, on choosing the right drivers, on choosing the right trucking, like that's the way logistics can survive, right? But it sounds like you guys were able to do it. So I'm happy that played out that way, even though I'm sure it was very tough. We simplify it, but I'm sure it was very tough.
Oh, it's brutal. I mean, if you just turn on the news in the last 4 years since March of 2022, I mean, I've had a lot of friends go out of business. It's been a tough environment, and it just keeps happening. And when the third parties, which are the brokers, start going out of business, the industry is in trouble as a whole, because that means everyone's strapped for cash. I mean, everyone's carrying out, these collections are stretched out. So yeah, and that's tough. And with rates the way they are, I'm sure we'll speak on that, but that's not my expertise.
So that's why we have Dr. Jaime here. He's a currency specialist. He trades currencies, loves ancient bills, but also knows a lot about the macroeconomic signals, and can tell us a little bit about, take us back to 22, right? Why did the interest rates start rising after being so low for so long? And how did that start affecting businesses? And the only reason I'm going back is, so I want to think about where we are today, but giving a little bit context of that rise of interest rates and never that downfall that everybody expected in 24, then again in 25, and now again maybe in 26, but we haven't seen really any return to the 1-2% type rates that we saw back in the day.
Yeah, sounds good. So first of all, thanks for inviting me. It's nice to be here and sharing my time with you guys, talking about these topics. First, as a disclaimer, most of the work I do is in academia. So a lot of what I work on is like theory, and try to understand also what the motivation is for the central banks, in this case, the Federal Reserve, to make the decisions they make. So I'm not much in the practice side of things, seeing, which businesses are thriving, or, which companies are going out of business. I'm not that familiar with that part, but I'll give you some, at least conceptual argument on, why things are the way they are and where do we expect them to be in the future, that I can participate on.
Correct.
So to begin understanding interest rates, so in countries, the central banks have the monopoly of managing the money supply. So they're the only ones that can control that. For the case of the US, the Federal Reserve Board is the one that is in charge of that. I can tell you more details about how the Federal Reserve Board is composed and how they make decisions as well. But in the big picture, you have this central bank that makes these decisions of where they want the interest rate to be. The central bank, in this case, the Fed, obeys a dual mandate. And the dual mandate is to basically maximize employment. And by maximizing employment, that means having your economy at its potential GDP. Make sure that you don't have resources or factors of production unused. So your idea is to be there, right? That has to do, of course, with, growth as well. It's implied. The other part has to do with maintaining inflation under control. It doesn't necessarily mean having zero inflation, but it does mean that you want to have inflation at your target, and you want to make sure that people understand that this inflation target is a credible signal that the Federal Reserve is going to do whatever it takes to be there. Because the problem that you tend to have when you have higher inflation than the target is that people stop believing the Fed. And if people stop believing the Fed, they're going to be constantly renegotiating salaries up and forecasting higher costs in the future. And even without the Fed touching anything, everything just becomes more expensive. So that would just by itself create more inflation. So the objective of the Fed is to make sure that doesn't happen, keep everyone in check, and give that that confidence to people, right? That inflation is going to be where they want it to be. So going back to Jordy's question, that's a little, background of, why, what's the role of the Fed in all of this, right? What happened in 2022? Well, you can tell prices went up a lot, right? The government injected over $3 trillion in stimulus during a short period of time. There's more money out there. People started, buying more. And because of this push of prices going up, and, also have to consider there were some supply chain disruptions and just some costs went up as well. But all of this together raised prices. And when you raise prices, the problem is that inflation gets out of control and it gets to that point where you could de-anchor the expectations that people have. You can stop believing the Fed if the goal is not met. So what the Fed can do, like the real tool that they have, is to increase the interest rate. Because by increasing the interest rate, you are, in a way, reducing the motivation or the incentives of businesses to invest more. And by having less investment, that's going to push the entire aggregate demand of a country down. And that decrease in the aggregate demand of the country is going to then bring prices down again. So that is the tool that the Fed has. Raise interest rates, make sure people are not spending as much, and that's the way to bring prices down. If you do not do that, and actually, if you lower the interest rate, what they're going to do is they're going to start investing even more, borrowing more, spending more, and that's the opposite from what you want. You want prices to go down. So that is the tool that the Fed has. That's why we saw that disruption around 2022 as a pretty desperate effort to control inflation.
Okay, so definitely as a method to slow things down. But they've stayed up, right? They've come down a few points here and there, quarter point here and there. People expected more. People wanted more stimulus in the economy. They started feeling like the US GDP might have been lagging, but it sounds like in the dual mandate, we weren't seeing really high unemployment, correct?
Correct. So that side of things has been pretty stable. Actually, everyone, like experts, overestimating the magnitude of COVID affecting the economy. Actually, the change wasn't that big. Unemployment right now it's at 4.5 is pretty, I would say, what normal rates of unemployment, I would argue. And the economy kept growing at its normal pace between 2 and 3%. So from that standpoint, that mandate is checked, right?
Okay.
No need to intervene. But inflation remains at over, I think it ended at 3% for the year that just ended. So the target being 2%, we're still a full point over. And that full point over is going to force the Fed to keep slowing things down until you reach the target of 2%. One more thing to mention there is that maybe in the eyes of investors, it's terrible to think that the interest rate is very high. Okay, like, the government is choking me, right? But with the current federal funds rate at 3.5%, it is high, but it's not as high as in other countries. In a way, it's almost healthy for the Fed to have an semi, I would say it's not really high. Again, in some other countries, it's way over 5%, but it's not near 1% or 2% where it was in the past. And one positive thing for the Fed of having the federal funds rate at that level is that you have more room to operate. What do I mean by that? If there's a recession tomorrow, the Fed can go ahead and lower the federal funds rate 2 full points to 1.5. That's a lot of room that can really help the economy get out of a recession. But if you're at 1% and you're in a recession, there's nowhere to go.
Okay.
You cannot help get out of that recession. And that happened in 2008 with the Great Recession. It also happened in 2001 with COVID. The interest rate was super low. Most of the policies from the government were fiscal policy. Monetary policy had no room to operate. And that's why the US accumulated so much debt, because all of this was stimulus packages that, again, put the US in a pretty compromised position regarding its debt.
Got it. So I might put words in your mouth, but it sounds like maybe 2026 is not a year where the Fed's going to make any major moves unless we see something happening, right? Because it sounds like they're kind of at a sweet spot and they have no incentive to go up or down unless we think that one of the major signals, for example, inflation or unemployment, is changing.
Yeah, I think more than a sweet spot is just where it needs to be at the moment based on
Okay.
technical arguments because inflation is still 3. That just, was recorded a month ago. And the Federal Open Market Committee, which is the one that meets periodically to decide what the federal funds rate is, did
Hmm.
not change it on January 28th, I believe, the last time they met just a week ago.
Hmm.
And they had this argument, all right, everything is under control, but inflation is still a little high. Let's not lower the interest rates yet. Let's keep finding a way for the economy to come back down to the desired level of inflation. So as long as inflation is in these levels, and again, we can talk about inflation, that's its own thing also to an extent, where that's coming from.
Hmm.
But as long as inflation is over 2%, you shouldn't expect the Fed to be wanting to lower interest rates much.
Okay.
If you get to 2%, then yeah, you should expect the like some actions there. But we're not
Okay.
there.
All right. Well, I mean, that's good to know. It helps us kind of plan for the future. I mean, I guess Jenny, from your vantage point, you're advising business owners, you're helping them with transactions. Are you seeing that people feel like money is still very expensive? Are people wanting those interest rates to come down? What's your take? What are you hearing out there?
Yeah. Yeah, great question, Jordy, and thanks for having me. So just kind of a quick intro. My name is Jenny Tran. I'm a principal founder of Jenny Tran Law, and I advise founder-led businesses on business, M&A, and tax. So I want to answer Jordy's question from, I'll call it those three perspective of like how businesses are adapting. The biggest shift that I'm seeing from an operations perspective is like a change in capital discipline, right? Owners who used to borrow are really starting to ask, like, do I need this? And from a growth perspective, we're seeing fewer leveraged expansion and more self-funded or like phased like purchases. Tristan, you told the story earlier about how in lieu of buying equipment, you were selling it off because you're prioritizing like cash and liquidity, right? So really a lot of my clients are really choosing, smaller equipment purchases. They're hiring slower. So that's on the operations side. Then on the M&A side, in terms of business sales, what a lot of owner operators are seeing as they're going out to market is that some of the financing structures are actually pushed like onto the seller. And so now a lot of sellers are seeing, I'll call it higher earnout ratios compared
Mm,
to like the cash they're getting upfront for the purchase price, higher debt that they're going to have to finance and carry back like themselves, or even higher rollover equity like percentages.
mhm,
The days of the 20% seller finance rollover equity like earnout versus 80% cash up front is really kind of gone. And what we're seeing is a series of creative restructuring for a lot of sellers who want to, for example, try to monetize their backlog but be able to go through like a business sale, like, right? And then lastly, from a tax perspective, there's a uniqueness to this feature. So just a quick discussion on the big beautiful bill on accelerated depreciation for equipment. So in other words, with the passage of the big beautiful bill, a lot of business owners are having the opportunity to buy equipment that is financed, but be able to fully depreciate the entire fair market value. So if they bought like a truck, right? For example, Tristan, educate us. How much would like a truck cost?
Oh, today? I mean, talk about, I like how Dr. Jaime was saying about inflation. I totally forgot about the rising costs with rates coming down or what shippers were willing to pay us, and then the cost of actual equipment. So today, a truck could be 180,000 to 220. When I
oh,
first bought my first truck in 2018, December, it was 130.
Yeah. Yeah.
So
wow.
So for easy
and a
math,
trailer, and remember
uh-huh.
the trailer that actually connects, the one that carries the freight that you have to connect to, which is a separate piece.
Right, right.
It's around. It went from it's probably in 2022. It was in the 70s to,
Okay.
and for a reefer another 120.
Yeah.
So
Wow.
So if like for easy math, for example, the fair market value of the tractor and the trailer was 250,000, and if a business owner were to finance 20% of it and pay 50,000, the benefit of the big beautiful bill is they get to spend $50,000 and fully depreciate the entire $250,000. So even though there is like a higher cost of borrowing, a lot of business owners are really taking a closer look on how to really balance cash, right? And so
Hmm.
what I'm ultimately observing is when interest rates were low, 1 to 2%, like during the pandemic, businesses were borrowing and operating for speed. And in today's environment, they're really borrowing for accuracy and survival. I hope I answered your question.
No, that's perfect because that's exactly what we're seeing, right? Anybody who sold or took a financing on in 22 or 21, even before, the expectation was everything's up and to the right. And so, people almost didn't care, weren't as disciplined in terms of the money that they were spending because things were accelerating, things were growing. And when we saw a little bit of the brake pull, via interest rates or rising costs or both, really, we started getting a lot of people more concerned about impairments of the people who had bought things, and then that immediately turns into, okay, we need to be more disciplined in our M&A as well. And so
Yeah.
when you have that again, perfect storm, I think it leads to good things, even though it's very painful, but it leads to that discipline that we're seeing, and I think that benefits everybody long term, right? When you're doing things in a sustainable way, I think you can build for the future rather than for the present, and that's a good thing. But
Right.
but I guess at 3.5%, right? So it sounds like the money isn't that expensive. We're hearing Jaime kind of say that. Tristan, I don't know if you feel like the borrowing is still expensive, but I guess for Jenny, are you seeing owners be too conservative then, maybe in this environment, unintentionally hurting long-term value?
Yeah, and you know, the analogy that I like to give you is that like when you go on a diet, like right, you want to lose fat and like not muscle. And
Mm,
so for a lot of business owners, because it's like their own bottom line, I want to first say that I like really feel you, but let's like trim the fat and like keep the muscle. And so the mistakes that I see for business owners is that they like start freezing everything. And it's not just the risk part, but like the opportunity. They don't spend as much as they should on marketing dollars, like tech upgrades, key
hmm.
hires, or like customer acquisition. And like while that protects, let's just say that quarter's like cash flow, right, as they're trying to plan, ultimately it's not going to be a good quarter when we look at the overall like valuations. And so, in one sense, valuations for business sales are driven by like growth and systems and like not just EBITDA. So,
Hmm.
I'm going to give you like an example. And the reason why I'm talking about this is because what I want business owners to like really always do is to keep their bookkeeper, like, for example, or whatever software it is that they're using for like, and as a plug, I'm a lawyer, like, I'm not an accountant. But the key here is, this business owner decided to reduce like their, let's call it bookkeeping spend. And then when it came time to sell, it was so difficult for like the buyer to be to reconcile like margins on products and the like. So the
Hmm.
buyer ultimately had to assume, I'll call it the worst case scenarios, right? And so while the underlying seller, like owner, saved like 150,000 like that quarter, which is a lot, it ultimately costed them like 2.5 million in the overall like
Wow.
sale. So I definitely see mistakes like made, and the mistakes are making decisions that aren't based on like long-term sustainability, like these knee-jerk reactions.
Yeah, definitely. Swing dieting has never worked for anybody, and you're starving yourself on one end and then binging on the other. I again, that return to sustainability, I think it's the most productive, but it's hard, right? It's hard when you're still scared, when things are not moving and accelerating the way they used to, and it's hard to remember, right? We were in maybe like a 10 to 12 year upswing, after a recession that not many remembered right now. And so I think it's hard to stay disciplined, and at the same time not get scared, I guess, when things are not going our way. I'll go back to Tristan kind of on that point, but I mean, as you're running your business, or if you were running businesses that are in your industry or near your industry, right? Manufacturing facilities, 3PLs, other logistics players. I guess what's one operational decision that you'd prioritize to stay resilient in 2026 and in this environment?
Um, don't get into trucking. I'm just kidding. I mean, I think one of the things that to stay resilient is really watch the behavior of the customers, where they're you got to check to see if what they're how they look like in their cash position. Are they paying on time? Um, and is the freight moving with contracted rates? And is there enough demand for everyone? Because there's a lot of us that have trucking companies, and like what Dr. Jaime said, there was too many people. Inflation stopped a lot of us from growing because of the expenses starting to go up. But before COVID there was free money, so everyone was growing at a rapid pace, like Jenny was saying. Like everyone was borrowing money, buying all these trucks. And then, yeah, we're left with zero demand we're fighting for leftovers. And so that's basically what happened to us in trucking. So you really have to watch out for the customers that you align with, because those customers are, are, basically that's how we get our cash, is through these customers.
Right.
And if they're in trouble, then we're in trouble. So really do your research and align with the right customers that are going to be your partners.
Yeah, I think that's right. I mean, for any business, really, right? You should be talking to your customers, and you should be paying attention if they're asking for a lot of concessions and a lot of discounts. You might smell something in the air, right? And I think it's good to again just stay vigilant and try to see around corners. Again, not always easy, right? You're doing contracts, you're rapidly moving things. It's hard to completely zone in on what could be happening. Sometimes people just get cheaper for whatever reason, but it's good to keep that ear on the ground. I agree with you.
Yeah, I mean, you got to underwrite the customers, right? Like, as much as they're underwriting you for trust and for service and for everything else. I mean, it goes both ways. I mean, how are they going to be treating you on the other side of it? So underwriting them is very something that I think every business owner has to do to survive uh, in this environment.
For sure, for sure. I guess going back to signals. So we're talking about staying on top of your customers, listening to what they're doing.
Mhm.
Do we see macroeconomic signals that we should be paying attention to, Jaime? Should we be looking at what the fiscal policy is doing? Should we be looking again a lot more at interest rates, inflation rates, unemployment rates? Like what are some of those indicators that as a business owner I should kind of be paying attention to?
Yeah, so I mean, the key macro indicators are always going to be GDP, GDP per capita. Then it's going to be inflation rate, unemployment rate. One thing that is becoming a little more, I would say, common in the news in the US is trade deficit. That's been on many newspapers more than before. And one thing that is not as much as it should be in the news is going to be the debt to GDP ratio, which is something that has changed quite a bit for the US. We can expand on that. I think that's one of the main risks the US as a country has, but I don't know if it's the necessarily like so linked to this discussion, but it does affect also interest rates. It affects the potential growth of the economy. If you see again that interest rates are pretty stable, that means that the Fed is still working on getting inflation under control. So that's what we can take from that. If we do see that the inflation rate is going down, then you should expect interest rates to go down. So the moment that we see that, that's what we should expect to see. However, the other thing we have to keep an eye on is unemployment rate, right? So far, the unemployment rate has been quite low. Again, this isn't like, definitely we're not in a recession from an unemployment rate perspective. Like, we're in the part of the business cycle that seems to be pretty stable. However, there are being a lot of changes in the labor market, and I'm not going to um, hide the elephant in the room. AI and some other technologies are going to make some jobs obsolete in the next years. That's just a fact. And people are going to have to find ways to get different skills to adapt to this, right? That's the way it has happened always when there's disruptive technologies that are going to help the growth of an economy. So from a GDP growth rate, we're seeing pretty good news in general, but that doesn't mean it's helping everyone. So we have to keep an eye also to see which sectors are benefiting more, which sectors find this to be cost saving changes. Some other sectors may just find some costs to go up and maybe are going to have a harder time growing, or maybe are even going to disappear, right? We have to keep an eye on that. And at the same time, this affects the employees these sectors have. So that's something we should keep an eye on. For the most part, again, I see a lot of stability as of now, but this technological changes are disruptive in nature. So I do expect changes in the next years or decades based from this.
No, that makes a lot of sense. I mean, Jenny, you were a partner at a big law firm before, and if you're seeing that firm, or something like a Deloitte or Ernst and Young, where I used to be, if you're seeing them take on way too much debt, if you're seeing them spend way too much money, and you're not seeing the returns, I would get worried, right? Because even though you're a partner in the law firm, you're kind of running your own business, but you're subject to the bigger piece. So I like thinking about the US as kind of like the biggest umbrella out there, and that we should be paying attention to trade deficits and debt to GDP ratios, because they become relevant, right? In a global economy, they're relevant. And so if I'm seeing the risk increase, I can only think that my own risk is going to increase as well. So that's good to note.
Yeah, definitely. The I'm pausing because this is a personal story that I'm going to share with you folks. I had the blessing to know that the pandemic was going to happen essentially 2 weeks before it actually did in 2020. And part of the reason why is my parents own their own importing business. And so they knew that the Chinese economy like shut down, like, right? And when you have such a large manufacturing production shut down, what does that mean for worldwide implications? And so once I saw that happened, like not only did I switch all of my underlying investments to the Chinese index, because you buy low and you sell high, I sort of knew that was going to be trickling down like as well to the US economy. And so I had at least 2 weeks of a heads up to plan for it, aside from being like judged like dearly, like, right? So back to your point, like Jordy, when business owners think that these underlying large trends aren't going to impact them, it's going to impact them. And to Tristan's point, in kind of understanding like the alignment, like so to speak, like it really is up to the business owner in their industry to kind of figure out in these macro like trends of spending, right? How it's going to impact them. So I'm going to use one example that I talked about earlier about how folks are spending less in advertisement. Okay. So if there's less in advertising dollars, like think about the industry that's being like impacted, like, right? And fortunately for Tristan, if it was, I'll call it the e-commerce of marketing, it might not impact him. But if it came down to like shipping, like product that was directly related to marketing, like that could have an impact. So I would encourage business owners to, again, look at the macro trend, like, Jaime was talking about, and then also take a closer look on how those trends impact their customers and like themselves as a way of reflection.
Okay, that makes a lot of sense. I always think that the economy is circular, and the impacts are felt early in some sectors and later in others, but it always affects things, right? Sometimes we push on the gas, and so the effect is quick and we almost don't realize. But there are still a lot of protective actions that I think you can take when you're seeing that volatility. And I want to ask Tristan, right? Are there any operational signals that you feel sometimes show that risk is increasing? Do you take any action on that? Do you wait till something actually has happened? Do you preempt it? Like, maybe tell us a little bit about protective actions that you've taken in the past, or you've seen in past cycles, that have allowed you to survive. Because you said a lot of your friends have lost their businesses, but you're still here. What are you doing differently?
Well, I mean, the signal that I look out for is the collections. I mean, I'm really big on that because in this market, you have to, or in trucking at least, you have to get very clear on how fast cash is coming in, how fast cash is going out, and so that you're not playing bank to these customers by being, financing their ARs. And so what I like to do is for defense is, of course, I have AR insurance that's helped a lot because
Okay.
beginning of 2023 or 24, my biggest customer went out of business out of nowhere, but I had him insured, and that really helped me. But I mean, I had to carry it for 210 days, even though insurance actually paid out, but they only pay 90%. So that's the first line of defense is having AR insurance. And one of them is
Okay.
to preserve obviously your cash. And don't hope that that customer can pay their bills. That's not a strategy. You have to really put that into place. And I've been preaching about insurance way, way, way before because I knew that that was the only way to protect ourselves from customers that could possibly go out of business. Because the longer collections will tell you everything you need to know about what the customer's financials will look like. I mean, if there's smoke, there's definitely going to be fire. So I made an orderly exit before I knew that the fire was happening by having insurance.
Wow, that's really good. I didn't even know you could do insurance on that, but that makes total sense.
Yeah. Hey,
But
Jordy, can I step in and also answer from a legal perspective?
yeah.
Yeah, I'm going to talk about one of my favorite topics, which is about talent alignment, right? I talked about how marketing spend is down, key employee hires are actually deferred, but more importantly, a lot of companies need to retain like their current and existing talent because for them to attract new talent is like so much more expensive. And so
Mm,
the conversation that I'm having a lot with business owners is really creating this share and share alike, incentive plan that doesn't actually cost them like anything, per se, because they
mhm,
don't actually have to pay them like yet, but in creating alignment with their workforce so that the workforce start having the owner mindset so that they are also spending every single dollar like they're an owner. And especially with unemployment being relatively low, and it takes 18 years to like build a human. The capital that I oftentimes talk to business owners about is not only about the cost of capital, but also like human capital, preserving it during this strategic like growth period or like survival period, right? Because
mhm.
we all know that if that one salesperson like left, that key contract or that key account would also like leave with them. So in today's economy with higher costs in deploying capital, I also tell my business owners, okay, who do we need to create incentive plans for so that the growth of the company is directly tied to those key employees, like as well.
That makes so much sense. I've been singing this song for a few years now, and I tell people all the time, right? Options, equity incentive plans, profit interest units, they tie people to your company and they make them align themselves to the long-term growth of the company. And there are some people that will always feel like owners, even if they're just employees, and there are others that need that incentive. But I think if you force that incentive on people, then you almost force those same actions. And so I'm a huge proponent of that. Obviously, we do 498s, and that's part of the work that we're doing on a regular basis.
Right?
But we use that valuation as a way to talk strategy, right? And talk who are the right employees that you want to keep. And sometimes that leads to others, unfortunately, being left out of the pools, but maybe they should be leaving anyways, right? And so I think that's a great strategy.
Well, I'd
I
like to
guess
add to that
yeah.
because there's a Bradley Jacobs. He's basically he founded XPO, but he's also founded $2 billion companies before that, like Waste Management, I think. And it's it's crazy because he said that same thing. I mean, he's like the Steve Jobs of trucking, and he keeps his employees and he gives them these options and says, "You can't sell them for 5 years because you're going to be with me for 5 years." And that's how he creates these awesome companies. It's really about the talent, and he does spend a lot of time on like just making sure that the package for them to stay is because like what Jenny said, that package has to be good enough for them to stay for the long run, and not
For
just like
sure, for sure.
run for the doors once the options like expire.
I mean, I'm glad this type of talk is making its way into business owners. I think it's the right mindset, and I think it helps the owners and the employees. So that's great. We're hearing a lot more about ESOPs, even though again, water cooler talk is all about AI. But these topics are coming forward a lot more. I guess Jaime, on your end, what's the water cooler talk at USC and the professor conferences and economics conferences? Are people worried about anything in particular? Globalization, anti-globalization? What did you think about the conversations happening at Davos? Were people talking about it? Is AI also overtaking the economics world? What are people talking about these days?
Yeah, there's a few things. I can split this question into two. What is faculty talking about and what are students asking you about? So yeah, from
Okay.
the student's perspective, it's all about AI. What skills do I need? I'm gonna be leaving school with a lot of debt. I need to get a high-paying job. So, they're in that process of adapting to that. So that's what they really care about, right? You know.
Okay.
I can teach them a lot of, macro theory and stuff like that, but ultimately what they also care is, okay, give me skills I can put in my CV to land a job, right? So we also, as faculty, we have to adapt to that and try to prepare them as well as we can and adapt ourselves, right? From more of a like across faculty conversations, I think there's a lot of things happening. So as I tried to explain earlier, I think it's somehow predictable what the Fed does. That's why I started chatting with, what's their goal, and then we can understand what they do, right?
Mm-hmm.
So as long as the inflation is high, interest rates are going to be stable. But we do, for example, project inflation to eventually go down. Why? Remember, we talked about trade deficit. So there was a big trade deficit. There still is. But based on that, what happened? The administration decided to impose tariffs, right? Tariffs were imposed, cost went up. So that's going to raise prices, right? However, you can see this as a one-time shot because this is doing, its prices have been going up, and this hit brings them up even further. So now basically everything is expensive, right? And this applies to cost, operation cost, even wages, like things are more expensive. But if things are not pushed up further, if there's not additional one-time hits, things are going to remain expensive, but there's not going to be inflation because inflation is the growth rate of that, right? So if
Okay.
things were expensive and they remain expensive, the inflation is not really changing much, right?
Mm-hmm.
So as long as that stays under that 3% and starts going down, then the interest rates are eventually going to go down. When is that going to happen? At some point in the near future, yes, but hasn't happened yet. There's many factors has led to that, right? So that is the things that are fairly predictable because we understand the way the system works, right? Some things that are unpredictable would have to do with the geopolitics you mentioned, right? What is going to happen to oil prices if there's a war somewhere, right? What's going to happen if there's sanctions to a country? What's going to happen if the US gets the oil from Venezuela? Like all these things almost come across as random shocks because they're unpredictable to an extent, right?
Mm.
So depending on what's happening here, the economy is, of course, going to be very affected. As I mentioned earlier, some other things we have to keep an eye on is debt to GDP ratio, because if the government is broke and the government now has to pay more for its debt service, for paying for interest on debt, guess what? Eventually, the US may have to start paying risk premiums on the interest they pay on their bonds.
Mm.
So guess what? That raises the interest rates, right? So that's now going against what you want to have if you're a business, right? You do not want interest rates to go up, you want them to go down, right? So that's another, I would say indicator to keep an eye on because the US has to eventually turn that around, right?
Okay, makes sense. But I mean, I hear you saying that it seems like there's a lot of stability, right? It sounds like people can act in the way they should be acting and be so concerned about the general economy, right? Are there going to be shocks? Are there going to be unexpected things? Yes, that's the nature of business, but you can live your life in fear. At least that's what I think. And I like your other point, which is things are expensive and they're going to stay expensive, but they're not going to continue to accelerate and get even more expensive. So I have this heuristic that I use now. If I'm going to buy something and I'm at the age now where everything's expensive, right? Because I remember what it used to be, I don't know, 15, 20 years ago. But if I see something, it's like, oh, wow, this used to cost, $5. Oh my God, now it's X dollars. Anytime I see something, I say, okay, it's $10 now, divide that by two. If it's still expensive at $5, I'm not gonna get it, right? So if I don't know, gum is $10, that's ridiculously expensive. I divide by two, it's $5. Gum shouldn't be $5 still, right? So I'm just gonna skip that. I'm just gonna buy the $2 gum, even though now it's $5, but it's $2 in old money. So I'm using that across my clothing spending and my restaurant spending and everything else. And it really helps. Just it just helps you ground yourself in your new budgets, right? We just have to get used to what the dollar is now. But for business owners, it's the same thing, right? So if I'm going to invest in capital, maybe for Tristan, right, I'm going to buy a new truck or a new hydraulic system or anything that I need for my warehousing. Maybe I just divide by two. If that's still expensive, there's probably an issue, right? But if I divide by two and it feels like the old prices, maybe that's not that bad. Maybe I should make the investment, stick to sustainable growth, try to think about ROI on what I'm spending, and just be responsible. But actually make investments that are gonna play out long term. So that's the way I think about it. Other people may have other opinions, but I'll ask maybe one of our few final questions. If we look at all of the past cycles, I'm sure all of you guys have learned different lessons, both on a personal and on a business kind of way. But what are some lessons that you learned the hard way and that you feel owners today, maybe owners that have had a business only for the last 10 years, that they haven't really thought about it, they're not ready, and you know that there's a certain pain that you learned a really great lesson from? Anybody can answer for this one.
Yeah, I'll jump in. As someone who's been an attorney for over a decade, but in legal for way more and coming from a family business, like as well, I feel like the classic non-preparation issue is constantly like reoccurring. So I'd like to close like my comment on telling business owners to really focus on tax because most of the savings don't happen like just in the deal. It actually needs to happen like at a minimum 5 years before or more. And the
Mhm.
analogy that I give you is if you were off course, like in the beginning, right, by 1 degree, 1 degree over 10 years become a really far off path, like trajectory. So the
Mm.
example that I can give you is one of my business owners, new clients, they're a C corporation. And they told me they're really smart, Jenny. Don't worry about double tax because I net my income to zero and everything's a salary, like, right? And I say, that's really great, smart business owner. First and foremost, in 2023, FICA tax no longer has a cap. And so now you pay an additional 1% when your compensation is in excess of 256,000, like 300. And so they're literally taking like $800,000 salaries, like, right? And so they're paying like an additional 1% that's like not necessary. And then I tell them, hey, because cost of capital is so tight, like every buyer of a business will absolutely require like the ability to depreciate assets so they can get as much net cash as possible from a tax
Mm.
perspective. And so when they get ready to sell, that double tax bullet, they end up biting it if they don't restructure. And frankly, certain elections take like 5 years to like be in effect, like, right? So I would say the failure to plan early, either from a governance or a tax perspective, unfortunately, is like one of those that constantly like repeats like through history.
Okay, so start thinking about that tax structure and the tax planning even 5 years earlier.
Yeah, yeah. I don't
That
make
seems
the
like a lot of
rules. The
time.
5 years earlier.
Okay. Tristan, are you already making some tax plans? I hope
Oh,
so.
yeah. I have, being part of entrepreneurs organization, I get to hear it a lot. So like my biggest lesson to answer your question is, it's just like what Jenny was saying. So, I'm on my 22nd year of being an entrepreneur. And I think just in the last 3 to 4 years, what I really learned was preparation is built like not during chaos or when things are hard in business, but it's like really being built way before that. You have to be cash disciplined. You have to execute on hard decisions. for survival. Jenny said it earlier, and for us, it's continuity, right? Because we've got to be in it long enough just to get lucky, and that's what my advice would be.
All right, perfect. I love that. Jaime, I know you say that you come from the theory kind of side, but I tend to think about business like there's a recipe on how to be successful, right? And then the problem is that you forget that what the recipe doesn't tell you is that, hey, you might burn your fingers while you're holding uh, the hot food, or you might cut your fingers while you're cutting the vegetables, and then you don't know what to do because there's blood all over. So that's what business really is, right? It's the messiness around the recipe, but the recipe still holds, right? You're gonna have to cook your bread in the oven. It's still gonna take 45 minutes, right? And so, what is that general recipe or general recommendations that you can tell middle market businesses, or really anybody in business, to think about, to keep an eye on, to just remember as they're hearing the news? What are those things, again, from that macro perspective, that maybe you would tell businesses to think about?
Yeah, I think what I would like to expand on is that although we do see stability at the macroeconomic level, and you can see this with the GDP growth rate, unemployment rate, that does not mean at all that all businesses are stable right now. There's actually a lot of change
Okay.
happening. Some businesses are growing a lot, some businesses are shrinking, some businesses may disappear, some occupations may disappear. So there's a lot of change in the landscape. And as I was mentioning, I'm not in the, I don't have my own business, but I think that the way to succeed in this is understanding, okay, the market is still there, the consumption is still there, the US is still the biggest economy, still buying as much as it used to be. What is selling, right? Who's buying? Like, where are things going, right? What kind of services are going to be there? And that is not going to be stable, right? Gotta
Okay.
always be considering that. Right now, as I mentioned, with a federal funds rate of 3.5, the interest rate you private bank offers you is way, like, it's way higher than that, right? So it's
Mhm.
expensive. It's not necessarily a good time to expand, but it may be a good time to start planning to see when the interest rate do go down, like, where do I want to expand, what kind of services, what or products I want to be delivering. And then you know, gotta be opportunistic, right? And then grow at that time, right? Right now, maybe survival is a good way to put it, like Tristan is saying, but still deliver to who is buying right now. And again, people are buying. The data tells consumption has not shrunk,
Yeah.
but not all the groups are buying in the same rate, right?
So take a look at the macro, but focus on industry, focus on sector, talk to your customers. I feel like we're all kind of saying the same things, right? So I mean, this makes a lot of sense. I still feel like I like your comment on stability, even though there's tons of events and volatility happening, but that gives me a little bit more confidence going into 2026. Hopefully, Tristan, you feel a little bit of that confidence maybe starting to reappear. But I mean, tell us if that feels like it is, or we should still be a little bit wary in 26.
Oh yeah, no, I feel like it's been a hard 4 years and things are changing. And like what Dr. Jaime was saying, I feel you just have to find that customer that who's buying, like what are they buying and what part, I mean, like who are they selling it to? And that's really what we're doing too, is being intentional about our customers. Who do we want to go after? Like who's actually moving freight right now and who's actually paying who wants to pay for service, and that's what's happening. And with a lot of businesses that have gone out, of the capacity pool, I feel like I've kind of outran everyone, but there's still the bear. He's still going after everyone. So, but it's slowed down a little bit because I think the bear's full right now.
Fair enough. Yeah. Well, if there's no bear, nobody would be running, right? So it's good to keep
Yeah.
us on our toes.
So yeah.
Jenny,
It's
anything to close us out?
Yeah, I would say for any business owner who's coming across this webinar, right? We're all intentional in getting the band together, like so to speak. And you'll notice that we come from a service provider's perspective as a business owner, like someone who teaches academically, someone who does like business sale and evaluations and legal. And so we're being intentional in creating like this underlying message. So feel free to reach out Thank you, Jordy and Kathy with Objective Investment Banking Valuation for having me.
Thank you so much, everyone. Really, I love the commentary. This is super helpful. It's great to learn from others. Tristan, right? EO is an amazing place to learn from other folks, and that's how I learn from other people's stories and mistakes and wins and successes. So I love hearing all of you guys' perspectives. Kathy will have information on everybody if you want to contact them. If not, please contact Kathy or myself, and we'll get those questions out to Dr. Jaime, to Jenny, and to Tristan, and keep the conversation going. They have LinkedIn profiles. They're happy to answer questions. Some folks are really busy, right? Dr. Jaime's in the middle of the semester. Jenny's growing her firm. Tristan's growing his. We're in the same boat, trying to expand. So everybody's busy, but we'll keep an eye out for questions and hope to connect with everybody listening.